Today, on June 16th, 2026, BlackRock did something to Bitcoin that almost nobody saw coming. Not a new spot fund, not another way to simply hold Bitcoin and hope the price goes up. Something stranger, something that turns Bitcoin's biggest weakness into a monthly paycheck. And by the end of this video, you'll understand why some people on Wall Street are already calling this the most important Bitcoin product since the original spot ETF approval 2 years ago. Quick note before we go further. This is not financial advice. This is analysis, so you can think for yourself and make your own decisions about your own money. Now let's get into it. Morning, afternoon, or night? For you right now, drop it in the comments, because where you're watching this from might matter more than you think once you see what this fund is actually built to do. Stay with me until minute 16, because what I'm about to show you about how this fund actually works changes the entire conversation around what Wall Street thinks Bitcoin is for. Here's the headline first. BlackRock's iShares Bitcoin Premium Income ETF, ticker BITA, began trading on NASDAQ this morning. It's not a copy of their flagship fund, IBIT. It's something built to solve a problem that has followed Bitcoin since the day it was created. A problem that has kept entire categories of investors, with entire categories of money, sitting on the sidelines for over a decade. And there's one detail in this fund's design, the way it caps how much upside it captures, that tells you exactly what kind of investor BlackRock is really chasing. We'll get to that. Keep it in the back of your mind. For over a decade, Bitcoin's critics have repeated the same line. It doesn't pay you anything, no dividends, no interest, no rent checks showing up every month like clockwork. You buy it, you hold it, and you wait. That waiting game has made early Bitcoin holders extraordinarily wealthy. Nobody serious is arguing with the results over a 10-year stretch. But here's the part that almost never gets talked about in the price-chasing corners of this space. Enormous amounts of money in this world are not allowed to simply wait. Pension funds need income to pay out to retirees every single month, regardless of what Bitcoin's chart looks like that week. Insurance companies need predictable cash flow to cover claims as they come in. Wealth managers running income-focused portfolios often have mandates that legally require yield, not just the hope of future price appreciation. Retirees living off their savings frequently need money landing in their account on a schedule, not whenever the market feels generous. Bitcoin, as it existed until this morning, didn't fit into any of those boxes. Not one of them. So an enormous amount of capital simply stayed out, not because these investors hated Bitcoin and not because they doubted the technology, because Bitcoin simply didn't speak their language. Now here's the part nobody is paying attention to. BlackRock didn't just notice this gap. They engineered a product specifically to close it. BITA generates income through a strategy called covered calls. In plain English, the fund holds Bitcoin exposure, mostly through shares of BlackRock's own spot Bitcoin fund, IBIT, along with some Bitcoin held directly in custody at Coinbase, and then it sells call options against a portion of that position. Selling those options brings in cash up front, called a premium. The premium is what gets passed back to investors as income. The trade-off is real, and it's the whole point. By selling away some of the upside, the fund gives up the chance to capture every single dollar if Bitcoin suddenly explodes higher. According to the fund's own filings, the target is an annual yield somewhere between 15 and 25%, while still aiming to capture at least 70% of Bitcoin's price gains. Read that again slowly. Income on a regular schedule, plus most of the upside, wrapped inside a single regulated ticker that anyone with a normal brokerage account can buy before their coffee gets cold. That is not a small idea. That is BlackRock attempting to make Bitcoin behave like an asset. Traditional finance has known how to sell for decades. Think about how strange that sentence would have sounded just a few years back. An asset famous for swings of 30, 40, even 50% in a matter of weeks, now wrapped into something designed to spit out a steady paycheck. That's the part that should make you sit up. The fund's own paperwork sets the annual sponsor fee at 0.65%, charged daily and paid out quarterly. That's a deliberately competitive number, clearly priced to undercut similar income products already sitting on the market. And the confirmation that this was actually happening today didn't come quietly. Bloomberg's senior ETF analyst, Eric Balchunas, one of the most closely followed voices in the entire ETF industry, confirmed directly with NASDAQ that the listing was locked in for this morning, just one day after the fund cleared its final approval from the Securities and Exchange Commission. When an analyst with that kind of access is tracking a filing day by day, hour by hour, that alone tells you this isn't some obscure product nobody in the industry cares about. And once you see what that actually means, you start to realize this isn't really a story about one ETF at all. Whenever BlackRock makes a move into Bitcoin, the entire market pays attention. There's a reason for that, and it isn't hype. This is the largest asset manager on the planet. When a firm of that size launches a new product, it isn't a guest dressed up as a press release. It's the result of months of internal research, legal filings with the Securities and Exchange Commission, and detailed modeling of where demand is likely to come from next. So ask yourself the obvious question: why launch an income-generating Bitcoin fund right now, in the middle of 2026, of all moments? Context matters here, and this is where things start to break down for the simple narrative most headlines are running with. Bitcoin has had a brutal stretch this year. The asset pulled back more than 25% at one point, and just weeks before this launch, it was sliding hard, briefly touching a low near $59,130. By the time BITA opened for trading this morning, it had clawed its way back up towards $66,000, helped along by easing tensions overseas and a fresh Federal Reserve meeting under newly seated Chair Kevin Warsh. Spot Bitcoin ETFs as a category bled roughly $2.5 billion in net outflows during the second quarter alone. In other words, BITA isn't launching into a euphoric, everyone's getting rich kind of market. It's launching right into a stretch where investors are nervous, where headlines have been gloomy, and where the old just buy it and wait pitch is a much harder sell than it was a year ago. That timing is not an accident, and this is exactly why this matters right now. When price appreciation alone isn't convincing people to show up, income becomes the new hook. A yield-bearing product turns volatility itself into a feature instead of a flaw. Every time Bitcoin chops sideways, swings hard, or grinds through a rough quarter, BITA's option strategy actually has more premium available to harvest. The fund doesn't need Bitcoin to keep printing fresh highs every month to deliver a return to the people holding it. That is a fundamentally different sales pitch than anything Wall Street has offered around Bitcoin before. First came simple access, with the spot ETFs back in January of 2024. IBIT alone grew into the fastest growing ETF in the history of the industry, now sitting on something like $49 billion in assets. Now comes specialization, with income products built for a market that has gotten noticeably more uncertain. Every time this asset class evolves to fit a new type of investor, the pool of people willing to put money in gets bigger, whether or not the price is making exciting headlines that particular week. It's also worth remembering that BlackRock didn't stumble into this timing by accident. The Form 8A filing that set this whole launch in motion went in just 5 days before trading began, a procedural step that almost always signals an imminent debut. BlackRock pushed that filing through specifically to beat Goldman Sachs to market, a firm developing a strikingly similar product of its own. In an industry where being first often means capturing the lion's share of long-term assets, that race mattered enormously to both firms. There's a phrase used inside the ETF world for exactly this kind of moment: first mover advantage. The first major fund in a new category tends to attract outsized inflows simply by being early, regardless of whether competitors eventually offer something just as good. BlackRock understands that better than almost anyone in finance, and they moved accordingly. Hit like if this is starting to make sense, because the next part is where it gets genuinely interesting. Here's where this story stops being about one fund and starts being about a pattern that's been building quietly for years. For most of Bitcoin's existence, it lived almost entirely outside the traditional financial system. Many of the people who built that system liked it exactly that way. No middlemen, no custodians holding your assets for you, no permission required from anyone. But over the last few years, Wall Street has been steadily building an entire infrastructure layer directly on top of Bitcoin, piece by piece. Custody solutions, so institutions don't have to manage private keys themselves or worry about losing a seed phrase. Spot ETFs, so anyone with a brokerage account could get exposure without ever touching a crypto exchange. Derivatives and options markets, so professional traders could hedge positions and manage risk using tools they already understood. And now, income products, so Bitcoin can sit comfortably inside portfolios that were never designed to hold a pure speculative asset in the first place. Each layer makes Bitcoin a little less foreign and a little more familiar to the people who control the largest pools of capital on the planet. This is where smart money is already moving, and it's worth sitting with that for a second. This isn't actually new behavior from Wall Street. It's the exact same playbook used on gold decades ago, when gold mining stocks and gold-backed funds let conservative investors get exposure without ever holding a physical bar. It's the same playbook used on real estate through REITs, letting ordinary investors collect property-style income without ever managing a tenant. And it's the same playbook already running in the stock market right now through covered call income funds like the ones tracking the S&P 500, which have pulled in tens of billions of dollars from investors who want yield more than they want raw upside. BlackRock is simply applying a proven formula to a brand new asset. And it's worth noticing how fast this formula gets applied once an asset crosses a certain threshold of acceptance. With gold, it took decades to go from physical bars in a vault to a fully financialized market with mining stocks, futures, and income strategies layered on top. With real estate, it took the better part of a century to get from owning property directly to publicly traded REITs sitting in millions of retirement accounts. Bitcoin has gone from a niche experiment mocked by most of Wall Street to spot ETFs to income-generating funds in roughly a decade. The financialization clock is running dramatically faster this time around, and that compression itself is a signal worth paying attention to. A pension fund doesn't want to learn how self-custody works. A financial advisor doesn't want to sit across the table and explain seed phrases to a 68-year-old client 3 years from retirement. What they do understand is a ticker symbol, a fact sheet, and a quarterly yield number that fits neatly into a spreadsheet they already use. BlackRock isn't asking the world to adapt to Bitcoin. BlackRock is adapting Bitcoin to fit a world that already exists, with rules, habits, and expectations that have been in place for generations. And remember, BlackRock isn't even doing this alone. Goldman Sachs has a similar income-style Bitcoin product expected to launch within weeks, likely in early July. Grayscale already runs a comparable covered call fund of its own. This is rapidly becoming a competitive category, not a one-off experiment from a single firm chasing headlines. When multiple giants race to build the same type of product at nearly the same time, that tells you something important about where they all believe demand is heading next. Firms this size don't race each other toward a market they think is shrinking. Comment below if you're someone who held Bitcoin through the early, chaotic years, because I genuinely want to know how a product like this sits with you. Does it feel like long overdue validation? Or does it feel like something is quietly being smoothed away from what made Bitcoin different in the first place? That tension is real, and it isn't going away anytime soon. Let's zoom out and think seriously about where this actually leads. Picture a retirement account that historically would never have touched Bitcoin. Too volatile, too speculative, too far outside the lines of what a responsible portfolio is supposed to hold. Now, picture that same account holding a fund that targets a 15 to 25% annual yield, still keeps roughly 70% of the upside, charges a manageable 0.65% annual fee, and trades on the exact same exchange as everything else in that account. Suddenly, the conversation changes completely. Bitcoin stops being an outside bet whispered about at dinner parties and starts being a line item that can plausibly fit inside a conservative, income-focused strategy built by a financial advisor who's never owned a Satoshi in their life. That's what people mean when they talk about the financialization of Bitcoin. It's the slow, deliberate process of wrapping, packaging, and reshaping an asset until it fits comfortably inside the systems that already move the most money on Earth. And remember that detail I asked you to keep in the back of your mind earlier? The 70% upside cap? Here's what it actually reveals. BlackRock isn't building this for people who believe Bitcoin is going to 10 times from here and want every last dollar of that move. They're building it for people who would rather give up some of that dream in exchange for certainty, consistency, and a number that shows up on a statement every quarter. That single design choice tells you exactly which type of investor BlackRock thinks the next wave of capital is going to come from. Supporters of this broader trend argue it brings deeper liquidity, broader adoption, and serious long-term staying power that Bitcoin has never had before. Skeptics argue Wall Street's version of Bitcoin slowly drifts away from the original vision, one trade-off and one fee structure at a time, until what's left barely resembles what early adopters signed up for. Both sides have a real point, and you don't have to fully agree with either one to see what's actually happening in front of us. Institutions do not spend years building products, filing detailed paperwork with regulators, and racing competitors to market for an asset class they secretly expect to fade into irrelevance. They build for the market they expect to keep growing for a very long time. And what happens next is the real story, because BITA is unlikely to be the last product of its kind. If demand shows up the way BlackRock is clearly betting it will, expect more variations to follow. Different yield targets, different upside caps, different risk levels, all built around the same core idea of making Bitcoin behave like something traditional finance already knows exactly how to sell to its clients. Are you positioned for that shift already? Or are you just watching it happen from the sidelines the same way most people watched the first spot ETF announcement 2 years ago and assumed they had plenty of time? That's worth sitting with, because the honest answer isn't the same for everyone, and it shouldn't be. Think about how this same pattern played out in the stock market with covered call income funds. A handful of years ago, those products were a niche corner of the ETF world. Today, they manage tens of billions of dollars combined, largely because retirees and conservative investors wanted equity exposure without giving up income along the way. If Bitcoin income funds follow even a fraction of that trajectory, the amount of capital that could eventually flow through products like BITA stops looking small very quickly. So here's the real question, and it has almost nothing to do with whether BITA pulls in $1 billion in its first week. It's what its very existence tells us about the sequence we're all watching unfold in real time. First, institutions dismissed Bitcoin entirely, treating it like a fringe experiment that would eventually disappear. Then, they quietly started studying it. Then they built simple products to access it, with the spot ETFs back in 2024. Then, they accumulated it at serious scale, with IBIT alone growing into one of the fastest growing funds in the entire history of the ETF industry. And now, just 2 years later, they're constructing increasingly sophisticated structures around it, designed for income, designed for risk management, designed to fit neatly inside portfolios that were never built to hold crypto at all. That's not a random sequence of events. That is, almost step for step, how every major asset class in modern history has eventually been absorbed into the mainstream financial system. And it suggests something worth taking seriously. The conversation happening inside asset management firms and trading desks right now is probably very different from the conversation happening in daily headlines, obsessing over the next 10% price swing. Headlines chase the next green candle or the next scary dip. Institutions build infrastructure meant to last for years, not for the next news cycle. And historically speaking, infrastructure is the thing that actually moves markets long after most people have completely stopped paying attention to the quiet announcement that built it in the first place. Could this turn out to be one of those quiet turning points? Nobody can say that with certainty, but it raises a real possibility that deserves your attention. Bitcoin's next major growth phase may not come from a fresh wave of retail buyers chasing a green candle on their phone at 2 a.m. It may come from increasingly sophisticated institutional money, slowly and methodically building positions through products that don't make for exciting thumbnails, but that move enormous amounts of capital all the same, quarter after quarter, with almost nobody outside the industry noticing. Do you think the system can hold, with Bitcoin getting wrapped tighter and tighter into the machinery of traditional finance? Or does this slow, steady process eventually change what Bitcoin even is at its core? 2 years ago, the idea of a major Wall Street firm building income products around Bitcoin would have sounded almost absurd to most people in this space. Today, it's simply Tuesday morning trading on NASDAQ. That pace of normalization is exactly why staying a step ahead of these structural shifts matters more than reacting to whatever headline is trending this week. So while most people today are glued to the price chart, checking if Bitcoin holds $66,000 through tomorrow's Fed decision, BlackRock just handed us a much bigger signal about where this entire space is actually heading. Bitcoin Income Fund, a new, deliberate bridge between Wall Street and digital assets, a product built specifically for investors who, until this morning, may have had zero interest in Bitcoin at all. The launch itself probably won't move tomorrow's price by much. What it represents might matter far more than that, for far longer than this week's news cycle. Every new financial product built around Bitcoin sends the exact same quiet message. Wall Street isn't preparing for this asset to disappear. Wall Street is preparing for it to stay, permanently, woven into the system it once stood completely outside of. What would you actually do if this trend keeps accelerating over the next few years, the way it has every single year since the first ETF approval? Are you watching this shift from a comfortable distance, or are you genuinely positioning for it? Share this with someone who needs to understand this shift before it's fully priced in, and everyone on social media is suddenly talking about it at once. Subscribe if you want to stay ahead of what's coming, because this is only the opening move in a much longer game, and we'll be tracking every single step of it right here on the Wealth Continuum. Drop a comment and let me know exactly where you land. Is BlackRock's Bitcoin Income ETF genuinely bullish for Bitcoin, or is Wall Street slowly taking the wheel of an asset that was never supposed to have one? This conversation is just getting started. I will see you in the next one.